the first half of the program, I discussed why the markets did what they did last week, and I just want to, again, for those of you who may have just tuned in, a lot of what happened last week was because of the uncertainty in China. China is a country of a couple of billion people that our companies here in the United States and all over the world count on for business. They are a major customer. When the major customer suffers, when the major customer slows down, so do the revenues of those companies. And it falls down to the softness in their earnings. The market is simply repricing what the market thinks those stocks should be worth, less the income, less the revenue that they would be generating from China. That is really it in a nutshell. Yes, there's other things going on, but that is predominantly why the markets are doing what they're doing and what they will continue to do probably until they figure out exactly where China is and when they will start buying our goods and services again. All right? So you're caught up. You didn't even have to tune in for the first 15 minutes of the show. Okay. Before I get to what I think the Fed needs to do in this interest rate environment, let's see how the markets did specifically this past week. It was ugly if you were long equities, I can tell you that much. The Dow Jones Industrial Average closed not only down under 18,000, and actually it's way under 17,000. The Dow Jones Industrial Average is down to 16,459. That was a haircut of 914 points on the week. I couldn't believe this when I saw it. It is now down 7.65% on the year. The S&P 500, the broader market, didn't fare much better. 1970, it was off 107 points on the week. It is also down 4.3% on the year. The technology-laden stocks of the NASDAQ, that makes up that index, 4,706. It was just not too long ago, a few days ago, that was over 5,000. But lost 337 points on the week, and it's even though it was down that much this week, it's still pretty much flat for the year. The Dow Jones Transportation Average. Remember, I've been talking about that over the last year, how I said it was starting to break down. Well, it did break down, and how I thought it would signal some things that might be happening today. Well, it is. It's now under 8,000, 78.72. The Dow Jones Transportation Average was off 378 points last week, and it is now down just under 14% year to date. Now, as I've always told you, when you have a sell-off like this, money goes, it has to go somewhere. When they sell stocks, where do they go? They're looking for safe haven. Yes, the mattress is one. Under the mattress is one of those safe havens. I have to tell you. And a lot of money, I'm sure, went there. And it also went to the Dow Jones Utility Average. That average was actually up on the week. And it's off just around 3% for the year. And it also found its place in the 10-year Treasury. That is now yielding 2.05%. You remember just a few short weeks ago, it was 2.48%. Here we are, just a couple of shows later. It's now right around 2% for the year, where I think it should be. In fact, I think it should be even lower than that. I've always said that, and I think it's heading lower yet. Money will find its way there in the next several weeks, and that average will be down under 2% in the not-too-distant future. All right, the Week in Review, as always, is brought to you by our very good friends at Minuteman Press. Give them a call. The number is 772-567-4645, or simply visit them at 494 5th Street Southwest. They're right here in beautiful Vero Beach for all your printing, shredding, and promotional item needs. So, the Fed, the minutes came out July 28th through the 29th of the Fed minutes. This came out this past week, revealing notable voices of trepidation as to the decision of what should happen to interest rates. One such voice was none other than the president of the Minneapolis Fed. Now, he proposes that the Fed sit tight in the interest rate decision. Just leave things the way they are. He's what we call a dove. Keep it low and let's see what happens. Now, he gives the following reason. The main reason was wait for inflation to creep closer to the Fed's target of 2%. We're currently at 1.2, 1.3%, depending on what data you look at. He does recognize that rates have to go higher, just not yet. A few, such as his, leads one to believe that we're not out of the economic woods just yet. I could sign on with his line of thinking, and I did. He had a post. It was in the Wall Street Journal op-ed. I think it was Wednesday, and you should read it. It's very important that you understand what these Fed presidents are thinking. They're very smart individuals. I don't always agree with them. I do happen to sign on with a small portion of his thinking. But here's where he loses me. He states that we still have bullets to fire when the next recession hits. Namely, another QE. That's right. That would be QE4. He also states that the Fed could decrease its already paltry rate they pay banks for their excess reserves sitting at the Fed. Now, if you don't know that rate, it's been averaging 0.13 to 0.18%. How do I know that? Because Wells Fargo, another stock that is a member of the Art of Investing Index, they have about $250 billion sitting in reserves, and they're getting somewhere in that neighborhood, 0.13 to 0.2%. Well, he proposes that if we were to have to fire another bullet to stimulate growth, that we can bring that down even further. Well, moving that rate, in my opinion, is not a major game changer. In other words, I don't think that would be significant enough move to bring the country out of a recession if that were the case. We're not in a recession, but he's saying that if that were to happen, if we were to slow down to the point where we needed stimulus, that we can just simply bring that rate down. We can also do QE4. Absolutely not. I couldn't agree with him anymore. Here's why. Now, and again, I believe that the Fed should raise rates, but they should do it gradually. I know, I have been an opponent to this strategy. I don't think our economy right now is strong enough. But remember, right now, I don't think that. But I think it has the potential to get there sooner or later. Wages are growing, if only modestly. And we're talking minimum wages in many areas in this country going from, say, $10 to $15 an hour. Okay, in addition to lower energy prices. Okay, it costs a lot less today to fill up your car than it did a year ago. Okay, that's number two. And by the way, I think the price of gas is going to go down even farther throughout the year. Here's one that really, I think, swayed my decision to increase the rates gradually. Home prices are rising to the point where many homeowners now have positive equity in their homes. We have not seen this since at least 2007, and I believe that equity is only going to increase over the next year. This all adds up to more disposable income for the U.S. consumer, And that's why I believe the Fed needs to be concerned about this. Here's my reasoning. Once the inflation genie comes out of the bottle, good luck trying to get her back in. I've always stated, never risk a lot for a little. A modest plan to increase rates from the levels they're at today, from 0 to 0.25%, is not going to have a long-term negative impact on the markets. I just don't see it. Conversely, if inflation is allowed to escape, that poses far greater risk to the economy and to your portfolio. We cannot allow that to happen. The Fed really has to be preemptive. And I believe that they will. There's a lot of talk about the Fed raising rates in September. And if it wasn't going to happen in September, maybe December. Well, that was on Monday. The markets Thursday and Friday cratered. Like I said, the markets were down. The Dow Jones Industrial was down with 900 points. I'm hoping that the Fed is not, they need to be careful not to get overly distracted by what's happening in China. We're a very strong economy right now, getting stronger. Next week, I'm going to talk about some very interesting stocks that you might want to look at that would be able to take advantage of where we're at in this economy right now, even on a global perspective. Some very interesting ideas at some very, very good value. Again, I believe that the Federal Reserve, coming up in their meeting in September, they need to adjust the rates gradually to bring us more to a normal pace of interest rates. They have to have something in their bag in the event a year or two or three down the road we recess. They have to be able to lower interest rates. They can't do that now. This nation cannot afford another QE. Don't worry about the markets. They'll be okay. You will be okay if you just tune it in here each and every week. This is Art Espinoza. This is the Art of Investing, and that's a wrap, folks. Have a prosperous week.
Well, baby, what I couldn't do with plenty of money and you, in spite of the worry that money brings, just a little filthy lucre buys a lot of things. And I could take you to places that you would like to go, but outside of that I've no use for dough. It's the root of all evil, of strife and upheaval. But I'm certain, honey, that life would be sunny with plenty of money and you.